Today's market rally wasn't really about broad economic optimism. What investors were responding to was a growing belief that slowing growth might actually bring easier financial conditions without seriously damaging corporate earnings. That shift in thinking helped drive another powerful move into technology and AI-linked assets. The S&P 500 finished up about 0.8% today, but the real story was the Nasdaq, which surged more than 2.3% as semiconductors and mega-cap growth stocks led the market higher. What's important here is that the rally was not broad-based. The Dow was essentially flat. Defensive sectors lagged again, and beneath the headline strength, investors continued concentrating capital into a relatively small group of AI-related winners. At the same time, Treasury yields moved lower. The U.S. 10-year yield declined again, which immediately supported long-duration growth assets like software, semiconductors, and AI infrastructure companies. That relationship matters because today's market remains extremely sensitive to interest rates. A large part of the AI trade depends on future earnings expectations staying highly valuable in present terms. So when yields fall, investors become more comfortable paying premium valuations for growth. And that's exactly what happened today. Markets increasingly interpreted softer economic momentum as reducing pressure on future rate hikes. In other words, the narrative shifted away from rates stay restrictive for longer and toward financial conditions may gradually ease if growth cools. That psychological adjustment triggered renewed institutional buying in technology. But there was another layer underneath the rally. The AI infrastructure story continues to overpower many of the macro concerns that would normally pressure markets. Large institutions increasingly see AI spending not as a temporary earnings cycle, but as a multi-year capital investment wave, similar to what cloud computing and mobile infrastructure created in prior decades. That's why money kept flowing not only into chip makers, but also into fiber optics, networking, cloud infrastructure, cooling systems, and data center supply chains. One example attracting attention today was the expanding partnership between Corning and NVIDIA AI Infrastructure Partnership, which reinforced the idea that AI capital spending is spreading beyond semiconductors into the broader physical infrastructure supporting data centers and AI deployment. At the same time, stronger guidance from ASML further reinforced confidence that hyperscalers and chipmakers are still aggressively committing capital toward AI expansion. And importantly, investors seem willing to overlook broader macro uncertainty as long as that spending trend remains intact. Oil prices also played an important role today. Crude declined despite ongoing geopolitical tensions surrounding Iran and the Strait of Hormuz. Markets interpreted that move as a temporary easing in inflation pressure, and that helped reinforce the idea that central banks may eventually gain more flexibility if energy-driven inflation risks remain contained. The weaker U.S. dollar added to that dynamic. A weaker dollar tends to support global liquidity conditions, multinational earnings, and broader appetite for risk assets. So between lower yields, lower oil, and a softer dollar, the environment became increasingly supportive for growth-sensitive sectors. But underneath the optimism, there are still signs of fragility. One of the biggest is market concentration. While indexes continue pushing higher, leadership remains unusually narrow. AI-linked companies continue attracting the majority of institutional inflows, while many cyclical and defensive sectors fail to confirm the rally. Healthcare weakened again today. Utilities underperformed. Financials lagged. Even energy stocks struggled despite geopolitical uncertainty. That tells us something important about investor psychology. Institutions are not positioning for broad economic acceleration. They're positioning for continued AI-driven growth leadership, combined with easing financial conditions, and that creates a very different kind of market environment. Because when leadership becomes this concentrated, markets also become more vulnerable to disappointment. If bond yields reverse higher again, or if AI spending growth slows even modestly, the market could face a much faster repricing than many investors expect. Another important signal today came from volatility markets. Even with equities rallying strongly, the VIX actually edged slightly higher. That suggests some investors are still quietly hedging risk beneath the surface enthusiasm. And that may reflect awareness that several unresolved risks are still sitting in the background. Geopolitical tension involving Iran and global shipping routes remains unresolved. Energy markets may currently be underpricing how quickly inflation pressure could return if supply disruptions escalate. At the same time, the weaker dollar introduces another layer of uncertainty. If inflation were to reaccelerate while the dollar continues weakening, bond markets could quickly become unstable again, and that would directly challenge the high valuation AI trade currently driving equity leadership. One open question investors are debating right now is whether this AI-led rally represents the beginning of a durable productivity-driven expansion, or whether markets are becoming overly dependent on a narrow group of companies carrying the broader indexes. I'd be interested to hear how you see that developing. Do you think markets are correctly pricing the durability of the AI investment cycle, or underestimating the risks tied to concentration and valuation? Looking ahead, the next major test for markets will likely come from incoming inflation and labor market data. Those reports will directly influence Treasury yields, Federal Reserve expectations, and ultimately the valuation framework supporting technology stocks. Markets will also remain highly focused on semiconductor earnings, hyperscaler capital spending guidance, and broader AI infrastructure demand trends. Because at this point, the AI narrative increasingly requires continued proof that spending momentum remains durable. The broader takeaway from today's market reaction is that investors appear increasingly willing to interpret slowing growth as a source of policy relief rather than immediate economic danger. That mindset is highly supportive for long-duration growth assets, especially technology and AI infrastructure. But it also means market stability is becoming increasingly dependent on falling yields and continued confidence in a relatively small group of AI-driven themes. And that's an important distinction investors should continue to watch carefully. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today. I appreciate you being part of the channel.